Covered call ETFs have exploded in popularity over the last few years. And when you first find them, they can look unbelievably simple. 8, 10, 12%, and sometimes even more paid every single month. And underneath them are indexes or stocks you already recognize, like the S&P 500 or the NASDAQ 100. So you start looking at these funds, and at first glance, they all seem like different versions of the same thing. Own stocks, sell calls, collect income. How different can they really be? Actually, very different, because every covered call ETF has two basic questions they must answer. How much upside are you selling, and how are you selling it? Once you understand those two things, the differences between these funds start to make a lot more sense. So today we're taking 8 of the largest and most commonly discussed high-income covered call ETFs and breaking them into 4 strategy families. No backtests, no winners, no taxes, no return of capital. We're just opening the hood and figuring out what these things actually do. So why am I picking these 8 ETFs? Well, I started with the top 10 diversified covered call and premium income ETFs by assets under management. 2 of them, DIVO and KNG, are a little different from the group I want to focus on. Both use covered calls, but the calls are written on individual stocks inside the portfolio. DIVO is really a dividend growth strategy first, with calls written tactically on selected holdings. K&G owns dividend aristocrats and uses a partial covered call program on those individual stocks. The other 8 are built around broad market option strategies tied primarily to the S&P 500 or NASDAQ 100, which makes them a much cleaner group for comparing the different ways these funds sell market upside. And the good news is you don't really have to learn 8 different systems. They break down into 4 strategy families: QYLD and XYLD, JEPI and JEPQ, GPIX and GPIQ, and SPYI and QQQI. They're not identical inside each pair, but structurally they're close enough that once you understand the family, you understand the basic idea. Let's start with the trade underneath all of them, the covered call. So what is a covered call? Let's say you own 100 shares of a stock trading at $100. You sell somebody else an at-the-money call option, giving them the right to buy those shares from you at $100 during the next month. And they pay you $3 per share for that right. That's $300 in option premium, and you receive it the moment you sell the option. Now there are 3 basic outcomes. First, if the stock falls to $95, you've lost $5 per share on the stock, but you collected $3 from the option, so the premium softened the loss a little. It didn't protect you from the loss, it just gave you a little cushion. Now next, let's say the stock rises to $103 instead. You collected $3 per share in premium, but the call takes away the gain above your $100 strike. So if the shares get called away at $100, you still end up with $103 of value per share. $100 from the sale plus the $3 premium. That's basically the same outcome as simply holding the stock at $103. The difference is now you no longer own the shares and you would have to buy them back if you want to stay invested. Or let's say the stock takes off and runs to $115. Your shares are called away at $100 and you still keep the $3 premium, so you end up with $103 per share in value, but if you had simply held the stock, you'd be sitting at $115. That would be $12 difference in the upside you gave away. That is the covered call bargain. Cash today in exchange for giving up some of the upside if the stock really runs. The ETFs we're about to look at run more sophisticated versions of that trade, but the economics don't really change. Premium comes in and some amount of upside goes out, which brings us right back to the first 2 questions. How much upside are they selling and how are they selling it? Let's first start with the simplest system. QYLD on the NASDAQ 100 side, XYLD on the S&P 500 side, and these funds are run by Global X. These are rules-based buy-write funds that write roughly 1-month calls at or near the current market level against essentially the entire portfolio. That means almost all of the portfolio is generating option premium, but almost all of it also has its upside limited once the market moves above these strikes. If the market goes sideways, the fund collects its premium. If the market falls, that premium gives you some cushion. But if the market runs, those calls start offsetting the gains above the strike, which means very little of the portfolio is left free to fully participate in the upside. The other defining feature is that this strategy is completely rules-based. Nobody is making a market call. Nobody's deciding, I think the stocks are about to run, so let's change the strategy. It simply follows the same basic process every month. own the equity exposure, write the calls, rinse and repeat. The trade-off is simple. You're giving up a lot of the portfolio's upside in exchange for a steady stream of option income. Next, we move into our second family of funds. JEPI is the S&P oriented fund, JEPQ is the NASDAQ oriented fund, and JP Morgan changes both parts of the equation. Start with the stocks. Both portfolios are actively constructed. JEPI is built around a diversified large cap portfolio with an emphasis on lower volatility, and JEPQ uses an active data-driven process to build its NASDAQ-oriented portfolio. But the bigger difference is how it creates the option income, and that's where equity-linked notes come in. ELNs sound far more complicated than the basic idea actually is. Think of an ELN as JP Morgan ordering a custom payoff from a bank. Instead of building every piece of the option trade inside the ETF, JP Morgan buys a note whose terms are designed to produce the economic result it wants. So you've got the stock portfolio sitting over here and you've got the option income engine sitting over there inside the notes. So the easiest way to think about it is that JP Morgan has two pieces working together. The fund owns an actively constructed stock portfolio and it uses those ELNs as part of the income generation strategy. The prospectus allows up to 20% of net assets to be invested in ELNs, but that number is an allocation limit, not a simple statement that 20% of the portfolio is covered by calls. The notes themselves contain the option income exposure, and JP Morgan does not publish one simple live overwrite percentage. The other important piece is where those calls are written. JP Morgan generally uses 1 month out of the money calls. Earlier, we used a $100 stock and sold the call right at $100, or once again, what is known as at the money. An out of the money call would be more like selling the strike at $103 or $105 instead. You collect a little less premium, but now the stock has some room to rise before the call starts limiting your upside. Now we get to Goldman Sachs. GPIC is the NASDAQ 100 version and GPIX is the S&P 500 version. Let's start with what the funds actually own. GPIC holds a portfolio designed to closely track the NASDAQ 100, and GPIX does the same with the S&P 500, generally using the stocks in those indexes and roughly benchmark weights. Then Goldman adds an actively managed call strategy tied to that same market exposure. Rather than writing calls on each individual stock, it generally uses options on benchmark-linked underliers such as ETFs that track the same index. Goldman generally overwrites somewhere between 25% and 75% of the portfolio. If coverage is closer to 75%, more of the portfolio is producing option premium, but more of the upside is also being sold. If coverage is closer to 25%, less premium is coming in, but more of the portfolio is left free to participate if the market runs. That coverage also isn't fixed. Goldman is trying to produce a relatively stable monthly distribution while still keeping meaningful participation in the market. So the amount it overwrites can change as market conditions and option premiums change. Goldman specifically states that when volatility is higher, option premiums are richer. It may be able to generate the same amount of income while covering less of the portfolio. Strike selection is active too. Goldman has said it generally sells at the money calls because those options bring in more premium than out of the money calls, which can allow the fund to cover less of the portfolio for a given level of income. That's the general practice Goldman describes, not a rule that every single call has to be at the money. The funds can also use other tools, including flex options, which allow customized strikes and expiration dates, but flex is something the prospectus says they may use, not something every trade has to be. Now we get to NEOS. QQQI is the NASDAQ 100 version and SPYI is the S&P 500 version. By now the basic idea should sound familiar. NEOS owns a portfolio designed to track its underlying index, then actively sells index calls to generate income. The short calls are typically written close to the current market level. So if the index is at 100, the strategy might sell a call around that area and collect premium. But NEOS has another tool available. It can use some of that premium to buy out of the money calls farther above the market. Now here's why that matters. If the index rises above the short call strike, that short call starts offsetting some of the additional gains from the stock portfolio. That's the ceiling we've been talking about throughout this episode. But now imagine the strategy also buys a call at $110. That costs some of the premium it collected, but if the market keeps running and eventually reaches that higher strike, the purchase call starts gaining value. So when the second call is in place, you can think about the trade in 3 zones. Below the short strike, the stock portfolio participates and the fund has collected option premium. Above the short strike, the short call starts holding back some of the upside. And farther above the market, the purchase call can begin adding some participation back in. There is one difference between the two funds worth knowing. SPYI's current documents say it will use a portion of the premium to purchase out of the money calls. QQQI says it may use a portion of the premium to purchase out of the money calls under certain circumstances. So I wouldn't describe them as running the exact same trade every day, but they belong in the same broader family. Actively managed index option strategies designed to generate income while maintaining some upside participation. And that's why the distribution rate by itself doesn't tell you too much. Two funds can both be paying around 10%, but they may be getting there through completely different trades. So before we compare the results, we have to understand what trade each fund is actually making. So now that we know what these 8 funds are actually doing, and we still haven't decided which one is better for each individual investor, the next question is, what actually happened when you own these strategies? We're going to start putting these funds side by side and looking at the things investors actually care about. Because there isn't one single answer that matters to everyone. Some investors are focused on the highest income today. Some care more about long-term growth. Some want the most reliable distribution they can find. And that's where this gets interesting. These funds can look very similar when you just look at the yield, but they can behave very differently depending on what you're actually trying to accomplish. We'll look at the performance, the distributions, the trade-offs, what actually happens in different market environments, and eventually the questions around things like return of capital, taxes, and whether these types of strategies can actually support a retirement income plan. So if you're holding one of these funds right now, put the ticker below and tell me why you bought it. Was it the distribution, the monthly income, or something else? And if this made the covered call world a little easier to understand, hit the like button and subscribe if you want to follow the rest of the series. Stay disciplined, stay patient, and I'll see you on the next flight.